It might seem like utter madness to invest in a company while its share price is tanking, but snatching up a great stock while it's falling in value can actually be a savvy move, almost like finding it on sale. If it bounces back, you have yourself an extra tasty profit and bragging rights as an investor with nerves of steel. If you're curious to know more, this video will explain how investing in a falling market works, some tips for choosing your stock, plus 3 key investment strategies and the risks. Take a look. If the key to investing is buy low, sell high, then investing in a bear market or falling market takes that concept to the next level. The idea is to buy great stock that will likely bounce back while its price is falling. For example, between February and March 2020, the price of Amazon stock fell by a massive 23%, likely scaring off investors. But by the time April swung around, its stock price had actually risen above its former peak earlier in the year. So, if you'd been brave enough to buy even one Amazon share on the 9th of March, when the FTSE had its largest intraday fall since 2008 here in the UK, and sold it just 1 month later on the 14th of April, you'd have made $588, more than 430 quid before fees. Choosing the right stock to invest in is half the battle. With a bear market, it's even more important not to just look at past share performance. You want to look at a company's price to earnings ratio, which can be calculated by dividing the share price by the earnings per share. When comparing these ratios, the higher the better. Historically, the average price to earnings ratio on the S&P 500 has been between 13 to 15, while Tesla, for example, has a price to earnings ratio of over 100. Give the company a quick Google too to check for any red flags like accounting scandals or unethical behaviour, which can have an impact on the price of a share. Investing in a bear market requires a lot of in-depth research into a company and their financials, as well as holding your nerve. With that said, investing in a bear market is not for beginners or those who like to meticulously watch their investments, as you don't want to freak out and panic sell if prices continue to drop. There are few greater pleasures in life than a cup of tea in bed and a savvy investment strategy. To navigate the complex world of investing in a falling market, you're going to need at least one of those, ideally both, to make the most of your money. One strategy is to keep an eye out for dividends. If a company can still pay dividends despite their stock price falling, it's a good sign they're feeling confident and still earning a profit. Even with the most thorough research, you can't be sure which stocks are going to bounce back and which will never recover. And in general, it's best not to put all of your investment eggs in one basket. A smart strategy here is to diversify your portfolio, which means spreading your investments between different financial products, companies, sectors, and countries. The idea being that if one stock drops unexpectedly, another could rise, balancing out your returns. Sector rotation is a strategy based on the economy going through a cycle. The economic cycle tends to move from periods of recession through increasing expansion to a growth peak that then tails off back into a recession. Investors can use these predicted patterns to anticipate stock fluctuations and move money between sectors accordingly. This can be a very risky strategy, as the stock market is still pretty volatile and it's not uncommon to see the economy skip a stage entirely. Investing in a falling market is not for the faint-hearted and requires a lot of thorough research into the companies you want to invest in. That being said, there are opportunities out there, so for more information on this, head to fineco.com/UK for our in-depth guide. Links are in the description below. If you enjoyed this video, subscribe to our channel right here and stay tuned for our next video. Thanks for watching.